Hello everyone, welcome to EduTap and welcome to the Mega Concept Revision series for PFRDA Grade A and for the IFSCA Grade A 2025. Now this series is very important for all of you, as in this series you will get multiple MCQs for your practice. You will understand that what is your level of preparation as well as what kind of questions actually do come in the examination, okay? As well as you can revise the concepts, the important concepts, and you can understand that where you are making the mistakes in answering the MCQs, okay? So this series is going to be very important for all of you. We have started with economics and the revision for economics. We have started with the MCQs for economics, and this is the part 3. So 3 parts, like this is the third part. After economics, you will have 3 sessions for management, then you will have 3 sessions for pension, and so on and so forth. You will have the different sessions for the different component, okay? So this is the Mega Concept Revision series. This is going to boost your level of preparation and you will understand that what kind of questions come in the examination, okay? So I hope you will utilize this series to the fullest, and I hope you are as excited for this series as we are. So this is the agenda for the revision series, where you are revising the concepts through the MCQs, and I hope that you are enjoying this series till now. Next, from tomorrow, the management is going to start, and you will start revising the management with Jalasar, okay? So now, without any delay, let me show you a big surprise from EduTap that we have brought for you. This ebook, this is the free ebook for which you can get the link in the description box below, and this ebook is providing you the decoded detailed syllabus for the you are getting the subject wise breakdown for the PFRDA Grade A syllabus, okay? So the syllabus is provided in the notification itself, but if you want to see the important subtopics, you want to see that from where the question actually do come in the examination, the extra topics from where the questions come. So if you want to see the detailed subject wise breakdown, if you want to see the decoded syllabus, so this is the ebook for all of you, okay? So for the PFRDA Grade A 2025 syllabus, all you need in one ebook for your syllabus, where you are getting the decoded, the detailed syllabus, where you are getting the subtopics that you have to study in each of the topic, in every topic, okay? So this is for the PFRDA Grade A, and you can download the ebook. That is very important for you to understand the subtopics from where the question comes, okay? Next is for the IFSCA Grade A students. This is the ebook. This is the free ebook for the previous year papers. Previous year papers, they are the guiding light in your preparation. So if you are preparing for the IFSCA Grade A examination, you need to have this ebook that is for the previous year papers, that will provide you the previous year papers of 2023 and 2024, and this is absolutely free of cost. You can download this ebook. The link is given in the description box below, okay? Now give me a thumbs up if everything is fine, if I am clearly audible and visible to all of you, and if everything is going fine. So give me a thumbs up and let's start with the first question, okay? So the relationship between money supply and price level under the Fisher's quantity theory of money is. So this is the first question that you have to answer in the time bound manner. So let's see that in the time bound manner how fast you are able to answer the questions. So this is the first question. Try to answer this question. So the relationship between money supply and price level under Fisher's quantity theory. So Fisher's quantity theory of money, the quantity theory of money has given the equation that money supply multiplied by velocity is equal to price multiplied by transaction. Now the transactions are considered constant and the velocity is considered constant. So what is the kind of relationship that is present between the money supply and the price level? You can see that if the money supply is increasing, the price level will also increase, and they have a direct relationship, because if the money supply is increasing, price level will increase, so they have a direct and proportionate relationship, okay? So here, according to you, what should be the answer? The answer is direct and proportionate relationship. So this is the idea that money supply and the price level, as per the Fisher and as per the other classical economist, there is a direct and proportionate relationship between money supply and price level, okay? So money supply can affect the price level. So this is the idea, this is the equation, that money supply multiplied by velocity, that how many times the money changing hands, is equal to price level multiplied by transactions. Now velocity is considered constant and the transactions are considered constant. So if the money supply is changing, the price will change in the direct and proportionate manner. The price level will change in the direct and proportionate level. And the classical dichotomy is present. That means the classical economists believed that the monetary variables, they cannot affect the real variables. The monetary variables will only affect the other monetary variables, like the money supply will affect the price level and such, and the real variables can affect the other real variables like the labor and your capital can affect the employment output and such. So this is the idea, okay? So this was the first question. So I hope you were able to answer this question. Now coming to the second question. So read the question very carefully and try to answer this question. The question is pretty easy, so you should be able to answer this question. So read the question carefully and try to answer. So anyone who is able to answer this question? Okay. So see, the question is that George B is worried with the way things have been going in the economy, like many of his friends and he himself has been unemployed for a long period of time. Okay, so there is unemployment that is present and the unemployment is increasing, as well as the prices keep going up and up. That means the prices are also rising. There is also inflation. So when there is inflation that is rapidly increasing and the inflation is increasing, and with that the unemployment is also increasing, or the unemployment is also present. So when the inflation is increasing and the unemployment is also present, so this is the scenario of the stagflation. This is the scenario of the stagflation. That is, there is stagnation. The output is stagnating. The output is either constant or it is decreasing, and so the unemployment is increasing, and there is inflation that is also happening. There is also inflation. Okay, so here, yes, the answer is E here, that is stagflation. So these are the different definitions that you need to keep in mind. Deflation means that the prices are decreasing, there is decreasing prices. Stagflation means that the inflation is increasing and there is also unemployment that is present. Disinflation means that the inflation rate is positive but it is decreasing. Reflation means that when during the time of contraction, when there is recession or depression in the economy, after that the government uses the policy, or the government adopts the expansionary fiscal policy. The government adopts the fiscal policy and the expansionary fiscal policy to expand the economy. So with the increasing demand, the prices start increasing. Okay, so this is reflation. During the time of recession or depression, the government adopts the expansionary fiscal policy to boost the economic demand and the prices also start increasing. Okay, so this is the idea. Now coming to the next question. In the case of cost push inflation, this causes a leftward shift in aggregate supply and leads to which and which. Okay, so the cost push inflation, in the cost push inflation, the price is increasing or decreasing, as well as the unemployment is increasing or decreasing, the output is increasing or decreasing. So try to answer this question. Anyone who is able to answer this question? So in the cost push inflation, it causes a leftward shift in aggregate supply. So what is the leftward shift in aggregate supply? So basically here you have aggregate demand that is downward sloping with the price. So with the price, the demand is decreasing and the supply is increasing. Okay, with the more price there will be more supply. Now aggregate supply has gone to leftward, like there is a leftward shift in aggregate supply. So here you can see that this is your quantity demanded and this is the price. Now here the demand is decreasing and the price is increasing. The demand is decreasing and the price is increasing. So with the decrease in demand, with the decrease in output, so here we have the output. Here we have the output that is being produced. So the output is decreasing. With the decrease in output, there will be less employment that will be created, and with less employment there will be more unemployment that will be present, right? So the rise in unemployment as well as rise in price, the prices are increasing, there is increase in price level as well as there is increase in unemployment also, correct? So there is actually rise in price level and there is rise in unemployment, okay? Because the output is decreasing, so with decreasing output, the unemployment is increasing. Yes, very good, Swami, correct. The D is the right answer here, rise in price level and rise in unemployment. This is the situation in the cost push inflation, where the prices are increasing as well as where the unemployment is also increasing and there is a leftward shift in aggregate demand. Now next question, a very easy question, and such kind of question can come in phase 1 particularly. So dash of the business cycle are known collectively as turning points, okay? So this is your business cycle. We have the expansion, we have the peak, we have the recession. When the contraction happens, recession starts. As the recession deepens, there is depression. Then there is trough, that is the minimum point. After that, there is recovery. And after that, expansion starts, and then again there is the peak. So what are the turning points in the business cycle? In the business cycle, what are the turning points? Very easy question. So try to answer this, that what are the turning points in the business cycle? The peak and the trough are the turning points in the business cycle, right? So this is the answer. The D is the answer here. So peak and trough, they are the turning points from where the economy starts turning. So after the peak, the contraction starts, and after the trough, the recovery and the expansion starts. Next is, in the balance of payment, there are two major accounts, the current account and the capital account. Now here, which of the following are considered a part of current account? So which of the following 5 components, which are the part of the current account? So that you have to answer. Yes. Try to answer this. So in the current account, I hope you know that in the current account, there is trade in goods, there is trade in services, and there is transfer payment. Okay. In the capital account, there is investment, there is external borrowings, and there is external assistance. So in the current account, there is transfer payment. Transfer payment means that we are getting the transfer payments, we are getting the unilateral payments, we are getting, let's say, gifts, grants, or we are providing the gifts and grants. Okay. So gifts, grants, and remittances, they come under the transfer payment. So this is a part of current account. This is a part of current account. The factor income from one country to another. Factor income means the income that is earned by providing the labor services, the capital services, or the entrepreneurship services. So that is trade in services. We are getting the factor income for providing our factor services. Okay. So this is also a part of current account. Borrowing comes under the capital account, as well as merchandise export. That means goods export. So there is trade in goods. So merchandise export also come under the current account. So the first one, second one, and fourth one, they come under the current account. The borrowings and the investment, they come under the capital account. So 1, 2, and 4 is the answer. That is, here D is the answer. Okay. So here D is the answer. So here you can see that in the current account, we have trade in goods, the export and import of goods, the trade in services, the factor services that are being traded, and the non-factor services that are being traded. Factor services is the labor services, the capital services, the entrepreneurship services, and such. Non-factor services are like the banking, shipping, such services. Okay. Then transfer payments, gifts, remittances, grants, they all come under the current account. Then in the capital account, there is investment, direct investment, and portfolio investment. There is external borrowing, external commercial borrowing, short-term borrowing. Then there is external assistance also. Okay. Now coming to the next question, that which transactions are also called below the line items or below the line transactions and refer to transactions that take place to cover the deficit or surplus. So try to answer this. Yes, Swami, I am not aware about it. Try to answer this question. So which transactions are called below the line items or below the line transactions, and these transactions, they take place to cover the deficit or surplus. That means if in the balance of payment, if the balance of payment is in deficit, or the balance of payment is in surplus. So to cover the balance of payment deficit or to cover the surplus, there are the dash transactions that happen. Okay. So first of all, you have to understand that what are autonomous transactions and what are autonomous transactions and what is accommodating transactions. So autonomous transactions, they are independent of the situation in the balance of payment. So let's say the trade in goods that is happening, the trade in services, or the transfer payments, the investment, the external borrowing, all these transactions that are happening, they are for the benefit, they are for the economic benefit. I am doing the export of the goods for my profit, for my earning, for my income. I am importing the goods for my satisfaction or for my benefit. Okay. So the trade that I am doing, or let's say the investment, the Indian investors, they are investing in other country to get the returns, to get the profit. The foreign investors are investing in our country to get the returns, to get the profit. So these are autonomous transactions. They are independent of the situation in balance of payment. Balance of payment is favorable, unfavorable, it is in deficit or surplus, doesn't matter. These are autonomous transactions. Okay, now accommodating transactions, they are done to cover the deficit in the balance of payment, or they are done to cover the surplus in the balance of payment. Okay, so accommodating transactions are the ones that are done to cover the deficit or to cover the surplus. Yes, very good, correct answer, Swami, very good. So accommodating transactions, so autonomous transactions, they are independent transactions, they are independent of the state of country's balance of payment. So the trade in goods, the trade in services, they are the autonomous transaction. Accommodating transaction, let's say the balance of payment is in deficit, it is in deficit. Okay, so when the balance of payment is in deficit, so to cover that deficit, the RBI uses the foreign exchange reserves. Okay, so RBI uses the foreign exchange reserves to cover the deficit. If the balance of payment is in surplus, the RBI uses the RBI send the money from the balance of payment to the foreign exchange reserves. So basically, if the balance of payment is in deficit, RBI will use foreign exchange reserves to cover the deficit. If the balance of payment is in surplus, the money from balance of payment will go to the foreign exchange reserves. Okay, now let's say that India does not have enough foreign exchange reserves to cover the deficit. Then the government can take the loans from the international organizations like the IMF and World Bank and such. Okay, so this is the basic idea, that to meet the deficit, government may borrow from abroad, or RBI can make withdrawals from the foreign exchange reserves to cover the deficit. So balance of payment should be overall equal to 0. If there is deficit, that is covered through the foreign exchange reserves. If there is surplus, so that money will go to the foreign exchange reserves. So these are the accommodating transactions that is done to cover the deficit or surplus. Now coming to the next question, so try to answer this question, that is in regards to the foreign exchange. Okay, so there is appreciating, the dollar is appreciating and the rupee is depreciating. So in this regards, try to answer the question. So try to answer. You have 15 seconds more. See, basically, if the dollar is appreciating and if the rupee is depreciating, dollar is appreciating, dollar is becoming stronger because there is more demand for dollars. There is more demand for dollars and there is less supply for dollars. So that's why the dollar is appreciating, right? The dollar is appreciating. The dollar is becoming stronger because we are demanding more dollars. We have more requirement of dollars. That's why the dollar is becoming stronger. So when there is low supply of dollars in India and high demand of dollars in India, then the dollars start becoming more stronger. Okay, then the dollars start appreciating and rupee start depreciating against the dollars. Now in this case, the supply of dollar is less and the demand for dollar is more. So what RBI will do, RBI will sell the dollars so that the supply of dollars increase, so that the supply of dollars start increasing and the appreciation of dollars can reduce. Okay, so the RBI will sell the dollars from its foreign exchange reserves to increase the supply of dollars so that the dollars can become less stronger. Okay, the appreciation of dollar can stop and the depreciation of rupee can stop. So RBI will sell the dollars. So this is the idea here. The answer is 2 and 4. 2 and 4. So this is the answer. So I hope this is very much clear that if the dollar is appreciating against the rupees and rupees is depreciating against the dollar, that is because the dollar is demanded more and the supply of dollar is less. So in this case, the RBI will supply the dollars to stop the appreciation of dollars and depreciation of rupee. Okay, so this is the idea. Now when there is more supply of dollars, when there is more supply for dollars and there is less demand for dollars, then the rupee is appreciating and the dollar is depreciating. In this case, the rupee is appreciating and the dollar is depreciating. When the rupee is appreciating, it is loss for exporters and gain for the importers. Now next is that in the case where the demand for dollars is high, when the demand for dollar is high and the supply of dollars is low, in this case the dollar is appreciating and the rupee is depreciating. The dollar is appreciating because there is more demand for dollars, so dollar is appreciating and the rupee is depreciating. Depreciation of domestic currency, that is rupee. In this case, it is loss for importers and gain for exporters. Okay, depreciation of rupee is a loss for importers and gain for exporters. Appreciation of rupee is a loss for exporters and gain for importers. This is what you have to keep in mind. Now in this case, when there is depreciation of rupee, RBI will sell the dollars. In case of appreciation of rupee, RBI will purchase the dollars to stop the appreciation, too much of appreciation. Next question, kindly read the question and kindly try to answer this question. So this is regarding the monetary policy. So here the SDF, that is standing deposit facility. See, there is a liquidity adjustment facility corridor. The standing deposit facility is the floor rate, the lowest of the rate, then there is repo rate, and then there is MSF rate. Okay. Now the SDF is less than the repo rate by 0.25%, that is by 25 basis point, and the MSF is greater than the repo rate by 0.25%, that is by 25 basis point. So the first statement seems correct, that the SDF is lower than the repo rate by 0.25% and the MSF is greater than the repo rate by 0.25%, that is 25 basis point. Now a facility under which scheduled commercial banks can borrow an additional one-day amount from the Reserve Bank of India up to a limit in their statutory liquidity ratio at a penal rate of interest is called repo rate. So the banks are able to borrow from the Reserve Bank of India at a penal rate of interest. Now this is marginal standing facility, because whenever there is a penal rate of interest, that is under the marginal standing facility. Okay. So it is not repo rate, it is marginal standing facility. The statutory liquidity ratio is the percentage of net demand and time liabilities. So basically the deposits. So SLR is the percentage of deposits that the banks have to keep as liquid asset in their own vault. So that is correct. The SLR is a percentage of NDTL that the banks have to keep with themselves in the liquid asset. So the first and the third statement is correct, and that's why the answer is C here. Okay. The answer is C here. So LAF, the liquidity adjustment corridor, has the SDF at the floor rate, then the repo rate and the MSF. MSF is greater than the repo rate by 0.25% and SDF is less than the repo rate by 0.25%. Then MSF is a facility under which, so basically the marginal standing facility, this is the facility when the bank has utilized the facility of the repo rate. That means the bank has taken loan under the repo rate and the bank is not able to further take loans under the repo rate from the Reserve Bank of India. Then the bank is in the liquidity crunch. Then the bank can take the loan under the marginal standing facility. That is, the bank is under the liquidity shock. The bank is under the liquidity crunch. So the bank can go to the Reserve Bank of India to take additional funds, to take additional loans. So the RBI will provide the loan to the bank, and the bank will provide a collateral to the Reserve Bank of India under the marginal standing facility. But let's say the bank do not have the government securities to provide the collateral to the RBI. The bank do not have the new government securities. So the bank can provide the SLR securities, because under the statutory liquidity ratio, the bank is holding the liquid asset in the form of gold, in the form of government securities and in the form of cash. So the government securities that is kept as the SLR securities that can be used to provide as collateral to the Reserve Bank of India, okay, under the MSF facility. And this facility can only be taken when the bank has already utilized the complete of the repo rate facility and the bank is under the liquidity crunch, okay. So this is the idea. I hope this is clear. So MSF is a penal rate of interest that is higher than the repo rate by 0.25%. This is the idea, okay. Statutory liquidity ratio, this is the SLR, is a percentage of NDTL, that is the net demand and time liabilities. This is the liabilities, these are the deposits that the bank has to return, okay. So these are the deposits that the bank has to return. So the NDTL, it is the liability, it is the liability is something that the bank has to return. So the deposits that the bank has to return. So net demand and time deposits. So out of the net demand and time deposits, the bank has to keep a percentage. So out of the deposits, the bank has to keep a percentage with itself in the form of liquid asset, in the form of gold, government securities and cash. That is SLR, okay. Now coming to the next question, that is, which of the following measures would result in an increase in the money supply in the economy? So which of the following would lead to increase in money supply out of these four? So which can lead to increase in money supply? So here simply understand, increase in cash reserve ratio. Cash reserve ratio is the percentage of net demand and time liabilities, of the net demand and time deposits that the bank has to keep with RBI. If the cash reserve ratio is increasing, that means the bank has to keep more money with the RBI. That means the bank will have less money to lend. The bank will have less money to lend. So this will decrease the money supply actually. Sale of government securities means if the central bank is selling the government securities to the bank, that means the bank will give money to the central bank. So this will reduce the money supply in the economy. This will reduce the money supply in the economy. Now, decrease in repo rate. If repo rate is decreased, that means the banks can take more loan at a cheaper rate, okay? And the banks will be excited to take the loans at a cheaper rate. So, the repo rate is decreased. This is the rate at which the banks can take loan from the Reserve Bank of India. If the repo rate is decreased, that means the banks will want to take the loan at the lower rate from the RBI. So, repo rate is the rate at which banks can take loan from the Reserve Bank of India by providing the collateral to the Reserve Bank of India. If the repo rate is decreased, that means the banks can take the cheap loan from the RBI. Decrease in SLR rate means that the banks have to keep less money with themselves and they can lend more. So, the third and fourth statements are correct in regards to the measures that will increase the money supply in the economy. Okay. So, yes, B is the right answer. That is not B. Actually, third and fourth. D is the right answer here. Okay, the second one is wrong because the sale of government securities, when the RBI is selling the government securities, RBI is taking away the money from the banks, so banks will have less money to lend. Okay, so third and fourth statements are correct in regards to increase of the money supply. So if the RBI wants the increase in money supply, the RBI can reduce the repo rate as well as the RBI will reduce or can reduce the SLR. Okay, so this is the idea, to increase the money supply, or RBI can purchase the government securities, because when the RBI is purchasing the government securities, the RBI purchasing the government securities from banks, RBI is giving money to the banks. This is the idea. Okay, so here the answer is 3 and 4. So now coming to the expansionary monetary policy. In the expansionary monetary policy, there is increase in money supply, so the rates have to decrease to increase the money supply. If there is contractionary monetary policy, that means there is decrease in money supply in the contractionary monetary policy, so the rates have to increase. Okay, so basically when the rates are decreasing, there is increase in money supply. Now the next question, try to answer this question. So which of the following is or are not the component of the non-tax revenue receipts component in the union budget? So in the union budget, there are two kinds of receipts. Right? There is revenue receipts, there is capital receipts. Now revenue receipts, they are the regular kind of receipts. So it includes the tax receipts and the non-tax receipts. Non-tax receipts, the government regularly receives the dividend. So on the yearly basis, the government receives the dividend, that is a part of profit that the government receives from State Bank of India, Punjab National Bank, Bank of Baroda, Reserve Bank of India. So these banks and the public sector undertakings, they provide dividend or the part of profit to the government on the regular basis. The government, let's say the government has given loans to the state government. So government of India has given loans to the state government. So state government has to regularly give the interest to the government of India. So the government is also receiving the interest payments. The government also receives the fees, fines for the let's say the challans that are coming on road. So fees and fines are given on the regular basis to the government. Grants are received by the government. Okay, they also come under the revenue receipts. Dividends and the interest the government is receiving, so these come under the revenue receipts. So revenue receipts are the regular receipts that consist of tax receipts, the GST that the government is receiving, the income tax that the government is receiving, non-tax receipts, that is the dividend that the government receives, the interest that the government receives, that is revenue receipt. Now capital receipt is like the loan that the government is receiving, and the government is receiving the money by selling some of its asset, so that comes under the capital receipt. Okay, so this is the idea. So loans, it come under the capital receipt, it is not a part of revenue receipt basically. So the D is the right answer here. Okay, here you can see that the revenue receipts consist of tax revenue and non-tax revenue. Tax revenue is the direct tax and the indirect tax, that is from the GST mainly. Now many of the tax have been accumulated under the GST. Okay, Now the non-tax revenue, interest receipts of the government, the dividend that the government is receiving, fees and fines that the government is receiving, the grants that the government is receiving, that is non-tax revenue. Capital receipts, these are the kind of receipts that the government is receiving that increase the liability of the government, that the government has to return the money, or that decrease the asset of the government. The government is selling the asset to receive this kind of money. That is recovery of loans. If the government is recovering, let's say the government had given a loan to the state government, now the government is receiving back the loan. So now the government is taking back the loan, that means the asset of the government is reducing because the government had given the loan. On this the government was getting the interest, but now if the government is recovering the loan, is getting back the loan, now on this money the government will not be able to earn interest as the loan has been recovered already. So disinvestment, the government is decreasing its asset, borrowings, provident funds, this is all the liability, the borrowing and the provident fund that the government has to return. Okay. Now coming to the next question, try to answer this question. So this is regarding your fiscal policy and budget. This is regarding your revenue receipts, capital receipts, deficit budget and such. So let's see how many of you have the clarity. Okay. So here anyone? I'm getting the answer C. Let's see. So the answer that is given is C, and that is absolutely correct. Very good. But first of all, let's see all the statements. So revenue receipts neither create liability. See, revenue receipts, they do not create any liability. They are regular receipts of the government. Okay, so they are regular receipts of the government. They do not create any liability for the government because these receipts do not have to be returned. They do not decrease the asset for the government. So they do not create any liability, they do not decrease the asset. But the capital receipts, they create the liability for the government and they reduce the asset of the government. Okay, so revenue receipts, they neither create any liability, they do not decrease the asset of the government, but capital receipts, they do so. The capital receipts, they create the liability and they reduce the asset. Okay, so this statement is correct. The deficit budget is used. Deficit budget is when the government is spending more than its receipts. When the government is spending more than its receipt, that is deficit budget, and government spends more whenever there is contraction in the economy, when there is recession or depression that is coming in the economy. In this case, the government has to spend more. So when there is recession, in this kind of situation, there is deficit budget where the government spends more. Capital expenditure, the government is spending on the capital expenditure. So capital expenditure is the expenditure that the government is doing to increase the asset in the country or to decrease its liability. So it is not increasing the liability, it is decreasing the liability of the government. So capital expenditure, first two statements are correct. Now third statement is wrong because the capital expenditure, it increases the asset for the government or it decreases the liability of the government. This decreases the loan of the government. So it is not increase, it decreases the liability of the government. Okay, revenue expenditure is recurring in nature and it is on salaries. So when the government is doing the revenue expenditure, it is the expenditure on salaries, subsidies, pensions and such. So this is revenue expenditure, correct. Expansionary fiscal policy means government is spending more, and when the government spends more, there is more demand, there is more production in the economy, there is more growth in the economy. So this is also correct. Okay, so this is regarding the revenue receipts and capital receipts that we have discussed, that revenue receipts do not create any liability, they do not reduce the asset, while the capital receipts do so. Then we have discussed about the deficit budget, when the government is spending more than the receipts. So this is done to cater to the recession, to reduce the recession, or to like the government spends more to cater the recession. Okay, now there are two key tools of fiscal policy, taxation and expenditure. Now the expansionary fiscal policy, in this government spends more. When the government is spending more, there is more demand, there is more production and there is more growth. Okay, next, the capital expenditure, this increases the asset in the country or this decreases the liability in the country. This is the idea. Now coming to the next question, try to answer this question. Now the question seems difficult, but it is very easy. Okay, because it is directly talking about the Phillips curve. So try to answer this question. So the question is talking about the Phillips curve. So try to answer. So if RBI adopts expansionary monetary policy, that means there is expansionary monetary policy means increasing the money supply. If RBI is increasing the money supply, this will usually lead to which of the following, and it also shows the relationship between the inflation and unemployment as per the Phillips curve. So as per the Phillips curve, the general relationship is that there is an inverse relationship between inflation and unemployment. Okay, so basically if the money supply is increasing, what will happen? With more money supply, with more money in the hands of people, there will be more demand. If there is more demand, there will be more production. If there is more production, for more production there is more employment that will happen, and the unemployment will decrease. If the unemployment is decreasing, as per Phillips curve, if the unemployment is decreasing, that will increase the inflation rate. Right? So decreased unemployment and increased inflation. As well as try to understand that when the demand is increasing, the production takes time to increase. So whenever the demand increases, there is the prices that start increasing also. So with the decreasing unemployment, there is increasing prices or increasing inflation. Decreased unemployment and increased inflation. Okay. I hope this is clear. Phillips curve shows the inverse relationship between these two factors. Okay, so remember this, that if the unemployment is decreasing, if basically the unemployment is decreasing, with the increased money supply, there is more demand, there is more production. With more production, there is less unemployment. So if the unemployment is decreasing, the prices are increasing, because if there is higher demand, the prices will start increasing. Okay, this is the short run Phillips curve that shows the inverse relationship between unemployment rate and inflation rate. Now coming to the second question, if the inflation expectation rise, the short run Phillips curve will shift where? It will shift to the right, it will shift to the left. Where is it going to shift? Try to answer this. So basically, if there is inflation expectation is rising, with the higher inflation expectation, that is, the people are expecting that in the future there will be more inflation. So people will start doing the storage now. The people will start accumulating the products. Let's say you wanted to buy laptop in the next month, but you know that the prices are going to increase of the laptop in the next month. So you will start buying laptop right now. So people will start buying the products right now. So they will increase the demand. With the inflation expectation, the demand in the economy will increase. With higher demand, the prices also start increasing. So if there is inflation expectation right now, that will lead to the inflation right now. Okay, so this causes the rightward shift in the Phillips curve. The Phillips curve actually shift rightward, so that at any unemployment rate, inflation is higher in the short run than before. So basically, when the inflation expectation rise, the inflation starts rising automatically. So basically, this is the equation, that the current inflation depends upon the expected inflation. So if the expected inflation for the future is rising, the inflation currently will start rising. Okay, this is the idea. So first of all, let's understand this inflation equation. So see, inflation, it depends upon the inflation expectation. If the expectation of the inflation is rising, the current inflation will start rising. Now the inflation is inversely dependent upon the unemployment. Okay, so basically this B shows the relationship between the unemployment rate and the inflation rate. Now if the current unemployment is higher than the natural unemployment. So this is natural unemployment. If the current unemployment, this is the current unemployment. So if the current unemployment is higher than the natural unemployment, that means there is higher unemployment. And if there is higher unemployment, there will be lower inflation. Basically, this is the negative sign, is showing that if unemployment is rising, the inflation will decrease. Okay. So basically, with the higher inflation expectation, the inflation will increase. But let's say if the unemployment is rising, if the current unemployment is increasing, that will decrease the inflation, because there is a negative relationship. As per Phillips curve, there is a negative relationship between the unemployment and the inflation. Now there is also this V. This V shows the adverse supply shock. This V shows that if there is a supply shock is coming, let's say oil prices are increasing, or let's say there is the increase in the cost of production. So any supply shock that is coming, that will increase the inflation. Okay, so this is the basic idea. Now what is happening, that inflation expectation is increasing. Inflation expectation is increasing, so that will increase the inflation. So at the same, this was the Phillips curve, this was the unemployment rate, and this was the inflation rate. Okay, or let's say this was the unemployment rate and this was the inflation rate. So at the same unemployment rate is same now. This is the same unemployment rate. Now at the unemployment rate, the inflation has increased because of the increasing inflation expectation. Because of the inflation expectation, the inflation has increased at the same unemployment. Okay, so basically the question is saying, or the answer is saying, that if the inflation expectation is increasing, now let's say unemployment is same, there is no change in unemployment, so there should be no change in inflation. If the unemployment is this 4%, so inflation should be around 1.75%. So if there is no change in unemployment, but the expected inflation is increasing, so the inflation at the same rate of unemployment, the inflation will start increasing. That will cause the rightward shift in Phillips curve. The Phillips curve has shifted from this to this. There is rightward shift in Phillips curve. So remember, whenever there is inflation expectation that rise, that cause the short run Phillips curve to shift right, and at the same unemployment rate, the inflation is rising. This is the idea. Now try to answer this question. Again, the question is basic, but you have to use the logic of the different concepts. So in the examination, different concepts can come in a single question. So try to answer this question. This formula is for inflation. This formula is for the Phillips curve. This formula is for the Phillips curve. For the inflation, this formula shows that there is inverse relationship, there is negative relationship, between unemployment and inflation. So this is the formula for the Phillips curve that shows that there is inverse relationship between unemployment rate and inflation rate. If the unemployment rate is increasing, the inflation rate will be decreasing. Okay, so this is the formula. Now coming to the next question, try to answer this question. Okay, so an expansionary fiscal policy, if the fiscal policy is expansionary, that means the expenditure is increasing. If there is expansionary fiscal policy, the government expenditure is increasing. So with the expansionary fiscal policy intending to reduce the unemployment. So if the expenditure is increasing of the government, the demand is going to increase in the economy. So with that, the production will increase. With the increasing production, there will be decreasing unemployment, because to produce more, there will be more employment. So unemployment will decrease. The unemployment should decrease. Okay. But what is happening, that in the long run, here the long run is given. In the long run, the unemployment cannot change, because as per the long run Phillips curve, this is the long run Phillips curve. In the long run Phillips curve, the unemployment rate cannot change. So that means the unemployment rate is not changing. Unemployment rate is not changing. So no reduction in unemployment, no reduction in unemployment. Now if unemployment is not reducing, that means production is not increasing. Okay, because there are no new factors that are producing, that are doing the production. So with the increasing demand, only the prices are increasing. With the increasing demand, the prices are increasing. The production is not able to increase because the employment, there is no employment that is generated. No employment can be generated. The unemployment rate is constant. Okay, so only the inflation can increase. Only the inflation can increase. Only the prices can increase. So basically, in expansionary fiscal policy in the long run, it is said that if there is expansionary fiscal policy in the long run, the demand will increase. With the increase in demand, the prices will increase, but the unemployment rate cannot change, because in the long run, the unemployment rate is constant. The unemployment rate is constant. That cannot change. So higher inflation will be there, but no reduction in unemployment rate, because in the long run, the unemployment rate cannot change. So remember that this is the long run Phillips curve. This is the long run Phillips curve. In the long run, the unemployment rate cannot change. So with the increase in demand, only the prices will increase, only the prices are increasing. Okay, so this is the idea in the long run. Now coming to the last question. Now this is going to be very important question. For your understanding perspective, many of you might not know about this point. So try to answer this question if you are able to. Otherwise, I will explain, okay? So a question linked to this has also come in the SEBI Grade A examination. So as per Phillips curve, the unemployment would decrease and inflation would increase. That means this is the short run Phillips curve where the unemployment rate is decreasing, and the inflation rate is increasing. So this will be because of which of the following? This will be because of aggregate demand shift left or aggregate demand shift right. Which of the following? So this is because of B, that is aggregate demand shift right. Okay, so when the aggregate demand is shifting right, that means it is increasing. With the increase in demand, there is increase in prices. With the increase in demand, the price starts increasing. With increase in price, there is increase in production. With increase in production, there is more employment that is generated. So unemployment decreases. So prices are increasing and unemployment decrease. So here the answer is B. So here you can see that as this is the aggregate demand, this is the aggregate supply. If the aggregate demand shift right, so price starts increasing. There is increase in price and there is an increase in output, increase in production, increase in output. To produce more, there is more employment. So unemployment reduces. So with the rightward, remember that with the rightward shift, with the right shift in aggregate demand, the unemployment decreases and inflation increases. Okay, so with the right shift in aggregate demand, the unemployment decreases and the inflation increases. Now with the left shift in aggregate demand, the opposite will happen. Okay, so with the right shift in aggregate demand, the unemployment is decreasing and the inflation is increasing. With the left shift in aggregate demand, the inflation will reduce and unemployment will increase. Okay, so this is the idea. So what will happen with the left shift in aggregate demand? So with the left shift in aggregate demand, if the aggregate demand shift left, so inflation will reduce and unemployment will increase. So this is shift in aggregate demand causes the movement from one point to another point. Now the shift in aggregate supply causes the shift in the Phillips curve also. So let's say that aggregate supply is decreasing or it is shifting leftwards. So aggregate supply shift left, because let's say oil prices have increased or there is supply chain disruption that is coming. The supply is not happening properly because of the geopolitical fragmentation, because of the war-like situation. The supply is not happening smoothly. So, or let's say the oil prices are increasing. So due to that also supply is reducing at the global level or at the country level. So supply has reduced. So before this was the output level and this was the price. Now as the supply has reduced, prices have increased. The prices have increased and the production have reduced. So prices are increasing, production have reduced. With reduced production, there is reduced unemployment, there is reduced employment and the unemployment is increasing. So you can understand that the prices are increasing. This was the price before, this was the unemployment before. Now the prices are increasing as well as the unemployment is also increasing. So when there is rightward shift in aggregate demand, the unemployment decrease, inflation increase. When there is leftward shift in aggregate demand, unemployment increase and inflation decrease. When there is leftward shift in aggregate supply, the Phillips curve shift right. And this causes the inflation to increase and unemployment to increase. Okay, as the aggregate supply shift right, this causes Phillips curve to shift left and it can, so Phillips curve is shifting left, so it can cause inflation to decrease and unemployment to decrease. Okay, so when the aggregate supply is shifting left, that is known as unfavorable supply shock. So the Phillips curve shift right. When the aggregate supply, let's say, is shifting rightwards, so this is known as favorable supply shock. And when there is favorable supply shock, you can see that the prices are decreasing, the prices will decrease and the output will increase. With the increasing output, there will be more employment and less unemployment. So there will be less unemployment and less inflation. So at the same like before this was the inflation, this was the unemployment. Now the Phillips curve will shift left. So when the supply is shifting right, when the aggregate supply is shifting right, the Phillips curve will shift left, and it will cause the inflation to decrease and unemployment to decrease. Unemployment to decrease and inflation to decrease. This is the idea, okay? Now I know economics is a little complicated, but this question has come in the SEBI Grade A examination, so it has a chance to come in the PFRDA Grade A examination also. So do revise it, do remember it, that if the aggregate demand is shifting left, it will cause Phillips curve to shift right. If the aggregate supply is shifting right, Phillips curve will shift left, okay? So this is the idea. Any confusion anyone has? So now before ending the session, let me show you that if you go to EduTap, if you go to edutap.in, you can go to EduTap's website, and then you can go to courses section, in which you can see the PFRDA Grade A courses and the IFSCA Grade A courses also. So if you tap on the PFRDA Grade A courses, here you can see the PFRDA courses, okay? Or you can see the IFSCA Grade A courses also. So if you tap on the courses section, you can see the IFSCA Grade A courses. So for the IFSCA, the courses have been launched. So here you can see that who all are teaching to you and what all you will be getting, okay? So for the IFSCA, the full video course has been launched for the phase 1 plus phase 2 as well as for the phase 2. So here, this is like what all you will be getting. You can see what is the price. You can see that there is the 71% off that is going on. So there is flat 71% off that is going on. You can use the IFSCA 71 code, okay? So this is for the IFSCA courses for the Grade A. If you want to prepare simultaneously, like you want to get the material for phase 1 as well as for phase 2, you can get the IFSCA Grade A Gold course, that is for phase 1 plus phase 2, where you are getting multiple things and the price you can see. As well as if you want to get the phase 2 course, that means you want to get the material for phase 2 only, you can see this course, okay? And do see that what all you will be getting as well as who all will be teaching you, so that also you can see, okay? So this is for the IFSCA. Now for the PFRDA also, in the courses section, you can go to the PFRDA and you can see the PFRDA Grade A courses, where you can see who all will be teaching to you, as well as you can get the PFRDA Gold course or Silver course. For the Gold course, you have the materials for phase 1 and phase 2. In the Silver course, you will get the material for phase 2, and you can see that what all you will be getting, like the concept classes, the videos you will be getting, notes, summary sheet, solved PYQs and such. You can see that there is flat 72% off that is going on. So for the PFRDA, and you can use the code PFRDA, okay? So this is like you can go to edutap.in website and you can go to the courses section, and here you can go and see the courses, who all will be teaching, what all you will be getting, okay? So this is it. Any confusion anyone has? Okay, yes. Regarding the PDF now, so you will get the PDF for the session in the Telegram channel of EduTap. So the PDF will be uploaded in the Telegram channel within 24 hours. So you can download the PDF of the session in the Telegram channel, and the link for the Telegram channel of EduTap will be provided to you in the description box below. So this is it. Thank you everyone for joining. Do download the PDF of the session, and the link for the Telegram channel will be provided in the description box below, in which you can download the PDF, okay? So any confusion anyone has? So your economics revision classes have been finished. From tomorrow you will have the management revision classes, okay? So if you have any query, you can ask. So I can see that there is no query. So this is it for today. Thank you everyone. Thank you for joining the session. Do download the PDF. I have given the explanation, so you can see the explanation and you can revise everything. And I have also explained that in regards to the shift that happens, so what is the idea, okay? So if the aggregate demand shift right or left, it will only cause, so basically I have explained you that if there is the shift in the aggregate demand, so there is movement in the Phillips curve, and if there is shift in the aggregate supply, there is shift in the Phillips curve also, okay? So this I have explained to you. So if aggregate demand is shifting, there is a shift in aggregate demand, the rightward shift in aggregate demand will cause increase in the inflation, decrease in unemployment, there is movement. And if there is leftward shift in aggregate demand, there is decrease in inflation and increase in unemployment. This is regarding aggregate demand. In case of aggregate supply, if the aggregate supply is shifting left, the Phillips curve will shift right. If the aggregate supply is shifting right, the Phillips curve will shift left, okay? So I've given you the explanation. This is it from my end for economics. Thank you everyone. Thank you for joining. And from tomorrow